Good morning. Welcome to Trader's Workshop. I'm Lex, your host, and today we have our same compadres, Jason and Mark, and we're going to talk about SKEW and where Vana is sitting in the marketplace. So stay tuned. Trader's Workshop. Yeah, Jason.
That was all right.
I know, it's just okay. It was a half-hearted. I've been traveling. It's just it wasn't full bore. It wasn't.
I wanted to hear something about bank panic, and
I know we're gonna talk
to see
about
a scary
panic.
face.
Yeah, we're gonna talk about bank panic and SKEW and tilt and things we don't even understand. By the way, the hat. Tell us about the hat, Jason. It's a Volland hat, I think.
Look at that. It's a
Mark.
Volland hat.
I hope we're on the short list.
Beginning to get some SKEW. I've got some other swag too. This is for all of our viewers. Right when Volland Live launches, we got these like little magnet things, and you can't see it at all on the camera.
No, but I can't. What does the magnet do? Does it have like a?
It's like a whiteboard magnet for you to put your securities and like all the key Vana levels and stuff like that. It's pretty cool.
Okay, I like it. Before we get started, couple things. I read about a spread that I had no idea. I think someone made this name up. It's called a fig leaf. Anyone hear of it?
I think I have actually, but I couldn't tell you what it is. I think it's of like the Christmas tree genre. Well, it's like the sort of ladder you got going, right?
Yeah. Well, how I read it is it's I call it the poor man's covered call, meaning you use a leap sort of option, a deeper in the money leap as your stock surrogate, and then you sell front month calls against it, and it's hence a fig leaf. Maybe it looks like a fig leaf on the graph.
I thought it was because you'd be naked if it went below your long call strike.
Another good point. I like that. Taking the fig leaf off. I do like that. All right. Very good. Okay. So first things first, markets. Yeah, so look at it's down a little bit. I actually thought today we might see a bit of a rally. It seemed like there's some solace with Credit Suisse yesterday. They got the $54 billion bailout or whatever line of credit from their government. So I thought there was going to be a little bit of some solace, although we did have a huge rally at the end of the day yesterday, right? Any thoughts on this whole banking thing? I have one thought or a few, but I'll let you guys go first if you have them. Anything, Mark?
Go ahead, Mark.
Bueller?
I was prepared to talk about Silicon Valley Bank last week, and then we had Signature on Sunday, and now we got a third bank to talk about this week. So, banks and financial crises tend to contagion, right? Where there's one, there's many.
Okay, let me ask you a risk question. Okay, you guys answer this how you see fit. SVB, Silicon Valley Bank. Allegedly, and I don't know the full details of this, allegedly they bought 30-year paper, right? Mm-hmm. Sunk their assets into 30-year bonds, okay, at probably 2% or 3% or some number. Inflation hits, Fed starts raising interest rates, and there's no systematic hedge against that horror story that bonds are getting hammered as interest rates are going up, and their value is just getting decimated. Now they have to sell bonds to realize the loss to come up with liquidity to pay depositors. Does that make any sense? Who at a big bank on a trading desk or any sort of hedging desk lets that happen? Am I missing something here, Mark, Jason?
I think that's the question.
I think we're stunned.
I mean, the other thing too is those depositors are so homogenous. Like they were all like VCs that are tech guys. So, I mean, if the economy hits that one group especially hard, which it has, because of interest rate rising, you would think you would almost over hedge on the bonds, because then you're getting hit from all angles with interest rate increases.
Yeah, I don't understand it. So anyway, that happens, and then it probably happens on down the line a little bit to these smaller regional banks who probably don't think like this. And they have the same sort of setup, and maybe in different varieties and quantities. But man, I just don't understand how that gets by the risk desk, right? I don't get it. I don't know. I guess I'm not supposed to get it. I take the other side. I think.
Why pay up for swaps when you can fork cash back over to your shareholders, right?
Yeah, I guess. Anyway, so I think we're gonna see a little more of that. But look at it seems like I hope it's kind of localized to this little group here, and it doesn't spread like wildfire a la 2008. That would be no good. Then we'd really have a volume to talk about.
Yeah, well, they're showing that that there are some issues, especially in the held to maturity, in that's held to maturity sections of banks hedging. So I mean, there's going to be because you can't hedge that with interest rate risk. So or rate swaps. So yeah, I mean, I don't think it's over, but I think that the low hanging fruit is falling off the tree now.
Yeah. Would you guys have bet me yesterday up on the day at any point? I'm talking SPOOs now, which I think they did go up on the day. If I'm not mistaken.
I would have gone on your side.
You would have, because that was
by around like 10, 11 o'clock. Because the thing is that not just that I kind of figured Credit Suisse would be that they'd be taken care of, but the liquidity was so poor yesterday, and Mark could probably talk about it with his little liquidity indicator that he has. The liquidity was so poor that once that started to come together a little bit, I figured we would squeeze up. We have so many puts being bought for this week, even deep out of the money that, and we'll talk about that in a minute with SKEW. We have so many puts bought that eventually that Vanna is going to push us up if there's even a hint of an implied volatility decline. Yeah.
I did do something relative to this. I kind of took a peek at all this, and we're going to talk about it when we get into the Vanna stuff. I sold a Diamonds put spread.
Okay.
At the bottom. I mean, I didn't know it was the bottom. I just said this is ridiculous, and I decided to throw one on. I mean, obviously, put credit spread. It's minimal risk. It's defined. So it wasn't like I was taking major dumpage, but I kind of looked at it at the end of the day. I'm like, oh, that didn't go so bad. So I still have it on though. Don't get me wrong. So today I'm probably giving some back. As a matter of fact, I can look. How much am I giving back today? No, not too bad.
Jason, you're totally right about the liquidity, right? Like just talking about SPX, like Monday was a third of what this year's average liquidity reading has been. Like both yesterday was about half, and Tuesday was somewhere in between, right? Like, and most of that's coming from the markets being significantly wider. Just the average vol width on these markets is wider. I mean, that tends to happen as you get to like more elevated vol levels, but like there was just, thinner, wider markets out there.
Are you talking about yesterday, Mark, or just generally of late?
This entire week, Monday being the worst of them.
Okay. Do you want me to show your sheet here? Will that give us some more insight?
That'll give insight about SKEW. I unfortunately wasn't prepared for the liquidity question, so I don't have a pretty chart.
Oh, that's okay. Let's go there then. Let's go to your add-in. Is that okay?
Yeah.
Okay. Tell us about this. This is SKEW 3 ways.
Exactly. So I have 3 different sort of ways that I like measure SKEW. And over the last couple of weeks, as we've been selling off here, I've been paying more attention to what we've been looking at. And so the first one here is a measure of the 15 delta SKEW. So ratio of your 15 delta put over your 15 delta call.
Which one is that? The orange or the green? Sorry.
So one's at 30 days and one's at 90 days.
Okay.
So the green is at 30 and the orange is at 90.
Okay.
So you definitely see a little bit more, and I believe this is year to date. Yeah. So you see a little bit more like choppiness in the 90-day figure, but it's overall, I'd say the mean is relatively steady, whereas this shorter dated SKEW has definitely started to tick up, and even more so the last couple of days, right? That like people are coming for that near-term downside. That it feels like that those puts are really what's getting bid up is in the near term. And actually, we'll see a little bit later on, but it's not only puts getting bid up, but calls getting sold. That like the SKEW is steepening. Like obviously the vol curve can shift like this, but like the SKEW is not just getting steeper at the far ends. And Jason, I think you mentioned some way out of the money puts getting bought recently, but it's these calls getting sold too that we'll see
Okay.
In this one.
Let me ask a couple questions about this guy. I want to make sure everyone understands. And same with me. So, okay, how is this computed again? And we're looking at, okay, I got it. So how is this computed again? You mentioned it was the something put over the something call, and we have a ratio of sorts. Can you explain that a little better?
Yeah. So what I look at is a steady 30-day 15 delta option. So it's like a theoretical option interpolated between like the current marks. But that's to give it, it's sort of like the VIX is a theoretical 30-day. Like this is a theoretical 30-day 15 delta option, 15 delta put over 15 delta call.
Okay, so it's put vol divided by call vol?
Price, actually.
Oh, price. Okay, price. And it's a 15 delta of each, right?
Correct. Yeah.
Okay, so and then you said that it's been.
If that was one, that would mean your puts and calls are the same price, and you have a totally flat skew.
Gotcha. So can you see my cursor in the screen here? See it moving?
I cannot.
Oh, I cannot. No, sorry.
Darn. Okay, so and to the far right side, right by that last box, you're saying that the 30, the FALC, I don't know what that means yet, 30 is rising over on the right side there. Is that what you're saying? That all of a sudden this put's gone higher or the call's gone lower, a combination of both is happening. Is that right?
Correct. And I see much more of a trend at the 30-day level.
Okay.
You know, from the beginning of the year that we've seen a steady increase in that near-term skew measure.
Okay. Got it.
Yeah.
Got it.
I'd be willing to bet too, Mark, that if you did a 1 day, like a 0 DTE line, it would be almost right on that 100%, which is why it's used so much, I think, now for hedging 0 DTEs.
Yeah, exactly. Like this is only 30-day, but like I suspect, I totally agree that at the nearer term, it might even be more exaggerated.
Yeah, I think that's right too. What is FALC? Is that the symbol, or is that something I'm just should know and I'm just blanking out?
That's my my bird indicator naming convention. So my 15 delta risk reversal is the Falcon.
Okay. I like it. I'm not sure why it's the Falcon.
Jason can't stand it, and I love that. But yeah, this is the Falcon.
The Falcon, huh? Okay.
I need to come up with something that's called the unladen swallow. Since you're in France, you know.
That looks like.
I love it. All right. So we're definitely seeing skewness. Now, in the skewness ballpark, when we see this rise, is there any one particular spread that stands out that we can take advantage of high volatility, or actually high skew, I should say? So we're not doing market maker stuff. We're buying out of the money calls and selling out of the money puts and selling stock or something in between to get delta neutral, are we? Or maybe we are.
I mean, you could definitely put on like a skew-based trade, right? So like if you're doing the short 15 delta put and long 15 delta call, right? Like that would be the same as long 30 deltas. So you could sell 30 deltas of stock against that and have like a totally skew trade on here. The way I like to do it, and I think is a little more practical, is that this is like means as a stock replacement strategy is like a 30 deltas of stock replacement. This is relatively cheap because you're getting more skew premium in those 30 deltas that you're synthetically long stock. So like as a dip buying exercise, perhaps, or like, you know, even in terms of rebalancing like a, you know, synthetic stock, like it's more expensive right now, which means selling that skew, i.e. buying the stock, is cheaper. Yep.
Understood. Okay, cool. All right, awesome. Let me get back to here. Jason, you get to be next. We're going to talk a little bit about Vana, I think. Maybe not.
Yeah, so we are.
What do you see with your measures here?
So I was just when Mark was talking about skew and, you know, its imbalance, I mean, the thing that I was looking at over the past week is how much the tails and the wings of the distribution have been bid. They've been bidding, 5, 10 delta puts like crazy and selling the calls. And this is all expirations, SPX Vana. And you could see as low as 2,500. And this is in September. We've been kind of just playing around with this. People are buying 2,500 SPX puts in September. People are buying 2,900, or I think that was also September. This was a little sooner. This was the 30 3,200.
Mm-hmm.
I mean, so, and then you look up here in the calls, people are selling 5,000 calls,
Mm-hmm.
5,200,
Mm-hmm.
6,500, all way out of the money later in the year. So I kind of thought this was applicable to seeing the steepness of the skew curve
Mm-hmm.
On both sides. So it seems like, though, as long as there is no bank news or something to validate these puts being bought, it seems like there's now some risk, some hedging that can provide a foundation for at least a small kind of rally going into later in the year. But then there's always going to be that risk of some bank folding or something like that happening that activates these. So I would project, based on this, implied volatility all along the curve is going to have a profound impact on the price.
Yeah, I don't think I remember seeing such distance of this kind of Vana in the past.
It's not common.
Yeah, right. I mean, 2,500. So it seems like a long ways away to have that. So what's going on? Is the investing public just scared of nuclear fallout here with these banks, and they're just super hedging, and they're paying for it with the upside calls, right? So
yeah, they're paying for it up here. I think that is probably the case. I mean, over the past week, I think people were very afraid of contagion, or they realized they were not hedged enough. And, for the past about a week ago, before all this started to happen, I was concerned about April hedging. There was no hedging for April. And I was sitting there thinking, we're gonna tank. I mean, there's going to be no dealer support underneath the market in order to get us to rally.
Yeah.
But because of this banking crisis, something was, some people put things on and deep out of the money too. So now we'll probably see some wide ranges at times, but there is at least some support for a modest rally, like the like default kind of positioning to just kind of be that modest rally little by little to the upside.
Interesting. Okay. So, and then the gamma part of this, that's all those spikes on the downside are all negative gamma guys, right? Yeah. Yeah.
So here, I mean, this is delta adjusted gamma, but if I look at regular gamma, these are all the negative gamma from sold puts or, sold calls. Sorry. And so, I mean, this right here is the JPM long, JPM has a short call. So the dealers have the long call. So that's what this is right here. But yeah, it's going to be negative gamma. So we're going to see probably wide swings, but it might be like wide swings with a trend up.
Okay. And are you able to tell where it's sort of what term structure it's sitting in? I think you mentioned
right now. I mean, we're going to have a refresh soon, but right now I can look at it through here.
Yeah.
I mean, if you want to see the JPM collar, you can go over here and you can see exactly what they're doing.
Yep.
Yeah. This is the call. Their deep out of the money put is, and this is gamma, obviously, but their super long deep out of the money put is nothing right now. But this is their long put right here. And this is their short call right here.
Okay, so that's
for the dealers, it's a long
trade,
call.
Yeah, that trade went up. That went up pretty massive in that month.
That trade always goes up every quarter. Like when we reach 331, we'll be, you could probably see it on the quarterly here in June 30, and you could probably try to predict what they're going to do.
Got it.
Yeah, see right now.
It's going to be interesting this month for that trade, though, because given the whole skew environment, I mean, that starts to set some interesting levels. Like I actually monitor an index that's exactly what those levels are. But because of the skew, exactly what you were talking about, those far out of the monies, if you're buying a put spread, that put spread gets cheaper the steeper the skew is. The more pump there is to that skew, like you're not just talking about the tilt of the skew, the more pump there is to that skew, the cheaper that put spread is, because the put you're selling at the far out of the money level is going to be more expensive, making your spread that you're long cheaper. which means you can sell a further out of the money call to finance that cash neutral. So in this skew environment, like the percent out of the moneynesses that they're going to be aiming for are going to be very different than usual.
Yep. I like it. Okay. Let me get us back here.
Actually, if you want to pull up Lex on the next slide, I have the index that I use to track that spread is called the gull because it's a seagull, where you short the call and long the put spread.
Wait a minute. Are you going seagull on me?
I'm going seagull. Sorry, here.
Okay.
We're seagull.
Here's the gull.
So
tell me this again. Sorry. It's you sell the call, buy the put spread.
Correct.
Okay.
And this is denominated in percentage terms. Okay. So the put spread, they lock at the 5% out of the money, 20% out of the money. So you're long the 5%, short the 20% out of the money put. So you're like buffered in that range. Okay. And then they sell calls or a basket of calls against all that. And the percent out of the money that they can go is a function of how much that put spread costs. Yep. So watching that change, like that was drifting down into the beginning of the year for the first part of the year. And then more recently, over the course of March, that started to get higher out of the money as skew started to get steeper.
Okay. So they could push that spread farther down. Is that what you're saying?
No, they keep the spread in the same place, but the call they can sell further out of the money because their put spread is cheaper because the far out of the money puts are more expensive.
That's right, because of the skew or tilt, whatever we call it. Yeah, we called it tilt for whatever reason. Okay.
We call tilt like if the curve's a smile, tilt is like this, and pump is when the wings go up like that.
Yeah, we called it smile, I guess.
Okay, yeah.
Smile or
pump.
Yeah,
I like it. Yeah, you're right about tilt. That's what we refer to it as what the slope of that skew is.
Or the tangent to the smile.
Yeah. Cool. Okay, so that's interesting. So they can push this call much higher up there. I like that. And they could probably take a wider put spread, right? Since that lower put is getting even pumped even more. Yeah.
In theory, of course, right? Like you could sort of move either of those levers. I believe the mandate though is a fixed put percentage.
Oh, it is
fixed buffer on the downside. Okay. And how much they have to give up is just sort of like the special sauce of the portfolio managers.
Got it. Cool. I like that. That's good. So, would you say, where did Jason go? Did he have to go to the bathroom or something? Where'd he go? Jason,
you into the really, really juicy stuff.
Yeah. So what was I going to say now? I forgot, Mark. No, I was saying though that these high volatility environments and these big skew environments, I think it gives us a great bit of opportunity, right? And in order to take advantage of the opportunity, you have to kind of understand some of this stuff. You don't have to be an expert in it, but you have to know how to position yourself and realize that this skew is steepening, or this is whatever you call it, flipping up. Now I can do certain things better than I can do in a normal environment, right? And then you could certainly take great advantage of it, I think.
Yeah, absolutely. I mean, whether you're trying to be offensive buying the dips, like I was saying, selling that risk reversal, or if you want to be defensive, your put spreads are cheaper now, right? Yep. Like you can adjust the tenor or dimensions of your put spread, because for the same cash outlay, you might be able to get more protection, longer term protection, whatever it might be.
Yeah. Okay. He is going to the bathroom. I can hear the toilet flushing. That's awesome.
I did say adjust the tenor. This very much is a near-term phenomenon, right? Like some of those, once you start going out 90, 120, 360 days, these curves aren't moving around as much. Like we're really seeing a lot of these movements in the sub 30, even 7-day kind of time frames.
Yeah. Okay. That makes sense. That's good to know too. Right. Do you think many retail people look out in term structure at all? You know what I mean? Like, let's call it 100 days and beyond, maybe 120 days and beyond. Do you think people really pay attention out there?
You would know better than I, but I think 90 days is an eternity. I think even 30 days is a long-term trade.
For retail folks, I 100% agree. Yeah. So, and that's why the stats on 0DTE are so unbelievable. Once they introduce that to the retail world, they're eating it up.
Oh, it's 50% of SPX volume.
Yeah, it's crazy. It's crazy. Yeah, I know. It's something else. Well, I guess that's good. You know, it's kind of the instant gratification theory, right? You know, why wait when you can have it today? I suppose.
Oh, the gamma moves on that are crazy.
Yeah, they don't think about gamma. Yeah, I mean, you put a position on,
but it's also cheap.
You're directional. You know.
Yeah, but that's where nickels become dollars, and you know,
right.
Yeah.
But by the end of the day, yep, that's exactly right. All right, well, very good. That's interesting. We're gonna can we take a look at this next time? I want to see how it changes over the course of a week.
Yeah, definitely.
So that'd be good.
What, the SKEW or the Vanna? The
Both.
Vanna's not going to change much because that was just
Vanna
so
won't
far
change
out.
much. Yeah, that won't change too much. But definitely want to keep track of the SKEW, see how it's going. Cool.
Time for a little risk reversal.
All right. Well, if anyone's out in California, in Irvine, I'll be there tomorrow night and Saturday presenting somewhere. I forget where, but somewhere in Irvine, California. So hang in there. Mark, are you going to be in Irvine tomorrow?
I will not be in Irvine tomorrow.
I know Jason's not. He's on the other side of the world. So
Mark is more on the other side of the world.
depends on how you look at it. All right, guys. Well, have a good rest of the week. We'll see you next week.
Happy trading.
Happy trading.